Hey, great people. Just touching base to discuss some ways to try and minimise your tax bill in the lead up to the end of the financial year. These are my top tips, and a couple things with this is the first tip I'm going to give you is you need to start planning to lower your donation to the ATO as early in the financial year as you possibly can. Now, the key with this is I see a lot of people and they come to me after the financial year wanting to plan around this and plan around the lowering their tax bill. And often once the line in the sand's passed, it's very difficult to make any adjustments or do anything from that point onwards. So a couple of key things that we should be thinking about or considering in the lead up to the EOFY is around planning out your expenses. So if you go on the ATO website or you have a good relationship with an accountant, I strongly recommend getting clear on what deductions you can claim as part of your job or this list can range from study costs, investment and tax advice related expenses, interest costs and work related expenses, and the list goes on. So being really crystal clear on what you can and can't claim is crucial to allow you to work out what deductions you should be picking up off the ground. I often see thousands of dollars in deductions just left sitting on the ground, not getting picked up. So make sure you're clear on that by either looking at the ATO guides on their website or talking to your tax professional to help plan that out. And that's the best way to make sure that you can plan everything, that you're claiming everything that you possibly can. Another option is around selling your investment assets at a loss. So if you've got capital gain, so you've bought an asset and you've disposed it and that's gone up in value through the year, and you have other assets that have done the opposite, they were here and they've gone backwards, what you can actually do is dispose of that asset and realise that loss. And it might be for reasons that you're no longer confident in holding that asset going forward. And selling those underperforming assets can help crystallize that loss in a financial year, and you can actually carry that forward into future years and offset against future capital gains as well. And this can lower your overall tax bill both now and into the future, and it has the added benefit of giving just a nice little refresh or tidy up of your investments as well. Another one is around bringing forward expenses prior to 30 June. So if you incur the whole expense in this financial year, you'll be able to claim that expense, assuming it is investment related or study related or things we've outlined earlier. But if it falls into a new financial year, you don't get that. So often people, if you've got a planned expense, it might be something that relating to your business or advice costs for your tax advice or interest costs on investment and so forth. If you can bring forward that expense into this financial year, it means you get the full benefit now as opposed to some of it deferring into another financial year. Because you don't get the full benefit of that deduction. This is something I always see. I.e., if you spend $1, you don't get a full dollar back as a deduction. You only get the tax rate that it deducts against back. If you don't have that planned expense in the pipeline, it's not worth just going out and making an expense to receive the deduction. So the idea is not to just go spending willy-nilly and buying random things that you don't necessarily need. Lastly is around using superannuation as a tool to lower your annual tax bill. This is the biggest chunky tax deduction that I generally find that you can get. So the annual limit of tax deductible contributions that you can put into your super are $27,500. Unfortunately, this limit includes your employer contribution, so there might be still a little bit left depending on what your employer's putting in. And we've used this to great effect for people even just doing small regular amounts throughout the year or something around this time of year as an additional payment to help lower your overall tax bill. It's also a really good strategy if you've got what we mentioned as capital gains or big disposals of assets that have gone up as well. You can actually put a lump sum into your super, and there's these other rules around that where you can carry forward prior unused limits to help offset big gains. So we've done that with great effects, typically when people are selling property and so forth. So there's another a short tip to consider. And obviously, once the money is in there, the long-term earnings are 15% as opposed to your marginal rate. So again, there's another long-term benefit. Lastly, just note on that one, once the money is in super, it's generally locked away with a key and you can't get your grubby mitts on it until you're 60. So that's definitely a consideration to make prior to that. Lastly, I always say try to keep good records if you can. I use notes on my phone, take photos of my receipts, jot them down in my notes. I've had spreadsheets and all these different things in years gone by, but I just find it's an easy way to track things ongoing. And then when you comes to time to with your tax professional, your accountant or the like, or if you DIY it, it's really easy to have good records and makes life super simple as opposed to trying to scratch your head and remember later. So be organised throughout the year. The old shoebox in the cupboard with all the receipts, that's just as good an approach. If you're really well organised through the year, it takes a lot of the guesswork and stress out throughout the year. And the last one is just make sure you get really, really top-notch advice from an accounting professional. This is not tax advice. We're not qualified. Qualified tax advisors, but talking to your financial advisor or your accountant can really help squeeze the lemon as much as possible. Hope that helps, guys. Take care and be in touch.